Hi, I'm Ryan Harding, and we're going to talk right now about mortgage insurance. Okay, mortgage insurance is required on all loans unless you put more than 20% down. Okay, so if you're putting less than 20% down, you're going to have mortgage insurance. Now, how you pay for that mortgage insurance is up to you. Okay, and there's actually three ways to pay for that. Number one is monthly, and that's what most people know about, right? You know, it's part of your payment. It's a monthly payment you pay every month. Another option, though, is that you can actually pay it upfront as a one-time fee, to avoid paying it monthly. That may make sense for you. A third option is actually having us, the lender, pay it in the form of a higher interest rate. Okay, and so sometimes you'll hear advertised, hey, this loan has no mortgage insurance. And it doesn't, but it's a little misleading because ultimately it's got a higher interest rate. And it's because essentially the lender's paying that mortgage insurance for you. Okay, so again, all loans have mortgage insurance if it's less than 20% down. It just depends on how you want to pay for it. So let me show you kind of some examples here, depending on how you want to pay for it. Okay, so assuming, let's say we have a $350,000 home, and let's say the interest rate is 5%. Okay, for easy argument's sake, mortgage insurance gets cheaper the more you put down. Okay, so if you do 3% down, that's one interest rate. Okay. One mortgage insurance rate. If you do 5% down, there's that one mortgage insurance rate. 10%, even cheaper. 15%, obviously the cheapest, before 20, which is nothing. You have no mortgage insurance at 20% down. Okay, so the more you put down, the cheaper that mortgage insurance gets. Okay, now again, how you want to pay for it is up to you. If you do monthly mortgage insurance, here's some options for you. Right, you can see that as time goes on, it does get cheaper if you put more down. Now, if you were to pay it up front, here you can see some options here too. Again, $9,000 up front, that's a lot of money. If you're putting 15% down though, hey, $1,700, that may be worth it, okay? And let me show you right here, this break-even point, okay? So what this is saying is, hey, if I paid it monthly, I'm paying $195 a month. But if I choose to pay it up front at essentially $9,000, my break-even point is about 46 months. Okay, so if I know I'm going to keep this loan for at least 46 months and I'm not going to make extra payments, I'm not going to refinance again, then paying it up front may make sense, right? Because after that 46 months, you're saving $195 a month, right? And that's nice. That's you're saving money. So it may make sense for you. Okay, it just depends on you. And if you're not sure, obviously talk to me. That's what I can help you with as we kind of navigate your future and trying to figure things out. That's my job. Okay, so lender paid mortgage insurance, if we're going to compare lender paid mortgage insurance at 5% down, okay, that would put a total payment of about $1,862. But you can see it's at a higher interest rate. Instead of 5%, you're at 5.375. Okay, and so but no mortgage insurance. And so you look at 5% with mortgage insurance, you'd be at $1,923 versus $1,862. So in this case, lender paid mortgage insurance on a monthly payment basis would save you money, right? You're paying, less money per month by doing lender paid mortgage insurance. Now, in the long run, you're obviously going to pay more by doing this because this mortgage insurance never falls off because there's no mortgage insurance. It's a higher rate, okay? But on this one, the mortgage insurance would eventually fall off once you reach that 20% equity, okay? So which one should you do? Well, again, it depends, right? It depends on what your plans are. If your plan is to stay in this house for only, let's say, 5 years, then lender-paid mortgage insurance might be a great option for you because in 5 years, that mortgage insurance won't fall off, not until probably 8 or 9 years. And so, hey, might as well enjoy a lower payment for the period of time that you're owning that loan because, now you're saving money and all you did is a little bit higher interest rate, but again, no mortgage insurance, okay? So some things to consider. Again, what should you do? So here's some questions to ask yourself. Will interest rates drop due to recession? Will you want to pull out cash and refinance? Are you planning to move? Are you planning to make extra payments? All these things are alluding to a possible refinance or paying that home off early. Because if you're thinking about paying it off early or refinancing to pull out cash or just to, try to go off the appraised value and switch it to a 15-year fix or something like that, you're going to mess with your loan. It may make more sense to, just pay monthly mortgage insurance and not pay an upfront fee or not do this lender paid mortgage insurance because ultimately you're not going to save enough money in that period of time, okay, to make it worth it. Because if in a year or two you refinance and you did lender paid mortgage insurance, you may not like that because now on the refinance, you're going to have to add mortgage insurance back on. Okay. Things to think about. If you're not sure on what to do, talk to me. Okay. We can counsel together about your situation, what we should be doing for your loan, and on the best way to structure it so that you're getting the best payment for your situation and paying the least amount of interest for your situation. Okay. Talk to me. Let's figure out how best to structure your loan.